Geoffrey, I wonder what value PMI indicators give us right now. This is survey data. It relies on sort of sentiment of purchasing managers, which has, their sentiment has been roiled just like the rest of us through this whole pandemic. What clear signals are we getting from that kind of data, or are you looking elsewhere?
Well, I'm actually looking at, how high things have been for the August numbers. And actually, I'm sorry to say, it gives us an indication of what the potential downside is, because we've seen in Europe, France, Germany in particular, services has actually been driving the positivity as economies and societies actually open up. But now with the onset of a second wave, and we've all read about the rise in cases on the continent over the last few days or so, then things can actually start to contract again or start to decline again. So this is actually going to drive sentiment up ahead. We've had some stellar prints in the services numbers. We know the manufacturing side is probably going, yes, it's recovered, but it's going to be the doldrums for a while because global demand is soft. But now the risk is absolutely to the downside with services, and I think that's what the ECB will be worried about up ahead.
Can the ECB do something that really move the needle as far as markets are concerned? I mean, you mentioned, and I think rightly so, that investors are expecting or are going to make decisions based on what they get fiscally out of the U.S. Isn't that the same here?
Yes, though if you look at the government support plans, say for France, for example, 2 years worth of support, that is almost a given. You do have a larger state sector. You do have expectations that the state will play a greater role on the continent. So the pricing there is more marginal. I think from the ECB's point of view, it's important to note that the minutes that we've seen just now, they were taken before the result of the EU summit in July, so they can get a fiscal boost there over the next 2 years or so. What's more important for the ECB is what happens in the shorter term. And here, probably the Fed will lead the way. If the Fed officially adopts some, let's say, average inflation targeting or outcome-based forward guidance, then that is a widening of policy differentials versus Europe, versus the rest of the world. So will Europe feel compelled to actually follow that, or at least keep the gap where it is, especially now that euro is trading at close to 120, rather than closer to 110, because that's a headwind for inflation.
Right, and that's exactly where I wanted to take us next, Geoff, and that is the strength of the euro. How worrying is this level, do you think, for European businesses, for the ECB even? I spoke to one strategist earlier this week who said it wouldn't worry the ECB until it got to 130. What's your line in the sand?
So I think the ECB will have to look at things on a basket basis, so on a nominal effective exchange rate basis and a real basis as well. As long as domestic demand, as long as households actually they can recover. So basically, if we see domestic retail sales still pick up, if we see domestically driven prices, if those numbers are firm, then I think they can be comfortable with euro-dollar trading at these levels. Of course, if we get another 10 figures within the next 2 or 3 months, that could be problematic. Currencies pass through, yes, there is an impact, but sometimes it's much more about pace, much less about levels. If we get to 130, say by this time next year, I don't think the ECB will have too much of an issue with that. If we get it in 6 weeks, then they will have a problem with it.